con Edward Moya, Senior Market Analyst de Oanda. Edward, good morning for you. Thank you so much for attending us.
Thank you for having me.
So, the US economy fell by 1.4% year on year in the first quarter of the year. How do you explain this?
Well, I think a lot of traders were anticipating a potential volatile number here. There was expectations that supply disruptions was going to have an impact on the data. And we have to remember that the U.S. was still battling the Omicron wave in January, and also the inflation story and the war in Ukraine was just about to start. And I think what you're probably going to see is inflation expectations were really starting to accelerate towards the latter part of that quarter. So right now, investors they're really looking at the data and saying, you know, the headline miss is rather concerning, but when you take a look at personal consumption, that still was fairly strong despite all those different headwinds. And I think there's still optimism that the economy is still on somewhat solid footing here, and that this figure does not disrupt any Fed rate hike expectations over the next couple meetings.
Mm-hmm. But consumption and investment are growing, as you said, but this has a lot to do with price growth as well. So what do you think about it?
Well, I think the market is very concerned about inflation, because this is the one thing that will force the Fed to tighten even more aggressive beyond the summer, and that is what could be the catalyst that sends the economy into a recession. So I think a lot of traders are going to continue to look to see, do we start to see signs that things are peaking over these next couple of months, and if not, then you'll probably see a lot more people become more bearish and more concerned that you know, a recession could hit the U.S. economy possibly as early as the end of next year.
Would the Fed continue with its aggressive roadmap after seeing this economic slowdown? Do you think the Fed will continue raising interest rates next week?
Undoubtedly. The Fed is locked in. We have to remember that the Fed has been late in fighting inflation, and right now this is an opportunity for the Fed that you know, the next couple of meetings are pretty much etched in stone. The Fed needs to raise rates by 50 basis points. They need to announce the formal balance sheet reduction plan, and you know, the June meeting is pretty much expected to be another half-point rate increase. I think the question mark is what happens at the meeting afterwards. Will that be a 50 or will that be a 25 basis point rate increase? And right now the Fed is on cruise control for aggressive Fed tightening, and this is probably what the market has priced in. So I think unless we start to see inflation get much worse, and right now there's a lot of optimism that we're not really going to see that, because we've gone through a good amount of earnings season, and there's been I think a lot of companies that have been able to pass on these price increases, and there's still strong optimism about the consumer be able to handle it, and that's mainly because both consumers and corporations have strong balance sheets. Not necessarily the lower to some middle-class families, but overall, when you speak broadly about the economy, still a lot of families are on strong footing.
Mm-hmm. So your answer reminds me the Joe Biden's statement that has sent to the press some hour ago. So he said in a statement the GDP number was due to technical factors. However, he did not explain what he was referring to. He also said the US economy is still resilient. So do you believe the same?
Very much so. I think that you have to remember that you know, this is a quarter-on-quarter reading, and you know, we're coming off a very strong fourth quarter. So I think, you know, everything that you're seeing about the labor market is still very tight, and if you're someone looking for work, you can still find work. A lot of companies are still providing higher wages. I mean, they're not keeping up with inflation, but they are providing pay raises, and when you consider, you know, where the economy seems poised to go, you know, these next few months are actually still expected to be fairly robust. I think there's still a lot of pent-up demand. You're probably going to see a very strong summer travel season, and for overall, when you take a look at how the market is positioned itself, it seems that there is a lot of investment going into the U.S. right now. I think there's this growth dominance theme that seems there's more ample opportunities here in the U.S. and that's going to be very good for the economy. And I think that you're probably going to see overall a lot of traders are going to want to stick to investing in the U.S. because there's too much uncertainty with Europe right now, and overall when you consider what's happening with Asia, China will probably bounce back strongly next month. Japan is still delivering more easing, and I think this spells for a very good outlook for U.S. equities.
Edward Moya, thank you so much for attending us.
Thank you for having me.